There are 5 Social Security changes happening in January 2026, and I can guarantee you that at least one of them is going to affect your wallet. Whether you're already collecting benefits or you're still working. And here's the thing that nobody's talking about. While everyone's focused on that 2.8% cost of living adjustment, there are 4 other changes that could either save you money or cost you money, depending on your situation. One of these changes could help you qualify for benefits if you're close but not quite there yet. Another one is going to hit high earners with an extra $520 in taxes. And there's one change that's actually making it harder for part-time workers to even qualify for Social Security in the first place. I'm breaking down all 5 changes, who they affect, and most importantly, what you need to do about them right now. If this is your first time here, I break down Social Security, retirement planning, and government benefits in plain English. Hit that subscribe button so you don't miss updates that could literally save you thousands of dollars. Drop a comment and let me know which of these 5 changes affects you the most. I read every single one. All right, let's get into it. Change number 1, the COLA increase and the Medicare trap. The big headline for 2026 is the 2.8% cost of living adjustment. Social Security retirement benefits will increase by about $56 per month on average starting in January. And increased payments to nearly 7.5 million SSI recipients will begin on December 31st, 2025. If you're currently receiving $2,000 per month, you're looking at roughly $2,056 starting in January. For married couples, the average increase is $88, raising the monthly benefit to $3,208, up from $3,120. Now, here's where it gets frustrating. While your Social Security is going up 2.8%, the standard monthly premium for Medicare Part B will climb in January from $185 to $202.90. That's a 9.7% increase. Let me break down what this really means for you. Your Social Security check goes up by $56, but your Medicare premium goes up by almost $18. That means your actual net increase is only about $38 per month, not $56. So that 2.8% COLA, after Medicare takes its cut, you're really only seeing about a 1.9% increase in your actual take-home benefit. The annual deductible for Medicare Part B will also increase to $283, up $26 from $257 in 2025, so you're paying more out of pocket before Medicare even kicks in. What this means for you. If you're already enrolled in Medicare, there isn't much you can do about the Part B premium. It's automatically deducted from your Social Security check. But this is exactly why the Medicare open enrollment period exists. Between now and December 7th, you can review your Medicare Advantage plans, your Part D prescription coverage, and your supplemental insurance to make sure you're not overpaying. According to recent data, people who shop around during open enrollment save an average of over $1,000 per year. So while you can't change that Part B premium, you might be able to save money elsewhere in your Medicare coverage. Change number 2. The taxable wage cap increase. Here's a change that affects anyone still working and earning a decent income. The amount of income subject to Social Security tax is adjusted each year to reflect national wage trends. In 2026, you'll pay Social Security tax on work income up to $184,500, up from $176,100 in 2025. If you're not earning close to 6 figures, this doesn't affect you at all. But if you are a high earner, here's what this means. You pay 6.2% of your wages in Social Security tax, and your employer matches that for a total of 12.4%. In 2026, if you earn at or above the maximum, you'll contribute $11,439 to Social Security, and your employer will match it for a total of just under $23,000. That's an increase of about $520 compared to 2025. Your employer pays the same increase. Who this affects? This hits lawyers, doctors, executives, business owners, successful salespeople, anyone earning over $176,100 who's going to cross the new $184,500 threshold. If you're self-employed, it's even more painful. because you pay both the employee and employer portions. So you're looking at over $1,000 more in taxes. The bigger picture. Here's what's interesting about this change. Earnings above that threshold are not taxed for the purpose of funding Social Security. And income from non-work sources like investments, interest, or withdrawals from retirement accounts aren't taxed for Social Security either. So if you're earning $300,000, you only pay Social Security taxes on the first $184,500. Meanwhile, someone earning $50,000 pays Social Security taxes on every dollar they make. That's why there's so much debate about this wage cap. From a practical standpoint, if you're approaching that cap, work with your accountant to understand how this affects your take-home pay and your tax planning for the year. Change number 3. Work credits are getting more expensive. This is the change that's flying completely under the radar, but it's huge for part-time workers, gig workers, and anyone not working full-time. To qualify for Social Security retirement benefits, you need 40 work credits, basically 10 years of work. You can earn a maximum of 4 credits per year. Here's the change. In 2025, you could earn 1 work credit by making $1,810. But in 2026, the amount required to earn a credit is going up. It will take $1,890 in wages to earn 1 credit, and $7,560 to earn all 4. That's an $80 increase per credit, or $320 more that you need to earn in 2026 to get your 4 credits for the year. Who this really affects. If you're working full-time, you're probably not even thinking about this. You'll easily clear $75-$60. But if you're a part-time worker, a gig worker doing Uber, Lyft, or DoorDash, a seasonal employee, or someone who took time off to raise kids and is now getting back into the workforce, this matters. Let's say you're working part-time making $15 an hour. To earn 1 credit in 2026, you'll need to work 126 hours. To earn all 4 credits, you'll need to work 504 hours for the year. That's about 10 hours a week, every single week. The stay-at-home parent trap. This is especially critical for stay-at-home parents. Let's say you worked for 8 years as a lawyer, doctor, or banker making great money. You contributed more to Social Security in those 8 years than many people do in 20. But here's the problem. If you don't have 40 credits, those 10 years, you do not qualify for Social Security based on your own work record. It doesn't matter how much you contributed. So if you're in this situation, even a minimal part-time job earning $7,560 per year could make the difference between qualifying for your own benefit or relying on spousal benefits, which max out at 50% of your spouse's benefit. Action. Step. Check your Social Security statement at ssa.gov to see how many credits you have. If you're close to 40 but not quite there, even a small part-time job could secure your eligibility before you retire. Change number 4. Earnings limits are going up. This change is critical if you've already started collecting Social Security but you're still working, or if you're thinking about claiming benefits early while continuing to work part-time. Social Security has something called the earnings test, and here's how it works. If you're younger than full retirement age for all of 2026, the earnings limit is $24,480. Social Security deducts $1 from your benefits for every $2 you earn over that limit. So let's say you're 64, you're collecting Social Security, and you decide to work part-time making $35,000 a year. You've exceeded the limit by $10,520. Social Security is going to withhold $5,260 from your benefits over the course of the year. Now, if 2026 is the year you reach full retirement age, which is 67 for anyone born in 1960 or later, the rules become more generous. The earnings limit for people reaching full retirement age in 2026 is $65,160. Social Security deducts $1 for every $3 earned over that amount until the month you reach full retirement age. Once you hit full retirement age, the earnings test goes away completely, You can earn as much as you want and keep every penny of your Social Security. The good news about this change: both of these thresholds went up from 2025. The $24,480 limit was $23,400 last year. The $65,160 limit was $62,160. So you can earn more in 2026 without losing benefits. Here's what most people don't know. The money Social Security withholds isn't lost forever. When you reach full retirement age, Social Security recalculates your benefit and increases it to account for the months you didn't receive payments. So you eventually get that money back in the form of higher monthly checks. But here's the problem. A lot of people don't plan for this. They start collecting Social Security, go back to work, and suddenly they're hit with a bill for $10,000, $20,000, or more because they earned too much. Critical action step. If you've started collecting Social Security and you're going back to work, or if you're planning to claim benefits while still working, call the Social Security Administration immediately. Tell them your expected income and ask them to withhold the appropriate amount from your monthly checks. Don't wait for them to figure it out 2 years later and send you a huge bill. Change number 5. Bend points are increasing. This is the most technical change, but it could significantly affect how much you receive if you're filing for Social Security in 2026. Your Social Security benefit isn't just some random number. It's calculated using something called bend points. Bend points determine how much of your average career earnings gets converted into your actual benefit amount. Here's how it works. Social Security takes your highest 35 years of earnings, adjusts them for inflation, averages them, and then applies a formula. In 2026, that formula looks like this. You get 90% of your first $1,286 in average index monthly earnings, 32% of earnings between $1,286 and $7,749, and 15% of any amount above $7,749. These bend point thresholds go up every year to account for wage growth. So if you're filing for benefits in 2026, your calculation uses these higher thresholds compared to someone who filed in 2025. Why? This is called the Great Equalizer. Here's what's interesting. Even though high earners pay Social Security taxes on earnings up to $184,500, the bend point formula means they get back a much smaller percentage of what they paid in. Someone earning maximum wages throughout their career pays in more than 11 times what someone in the lowest earning bracket pays. But because of how bend points work, they only receive about 3.65 times more in benefits. This is by design. Social Security is meant to be progressive, providing more relative support for lower income workers. What this means for you. If you haven't filed for benefits yet, your calculation will use the 2026 bend points, or whatever year you file. If you're deciding between filing in 2025 versus waiting until 2026, this is one small factor in favor of waiting. Your benefit will be calculated using slightly higher thresholds. But realistically, the much bigger factor is your full retirement age and whether you're claiming early or delaying. Every month you delay past full retirement age up to age 70 increases your benefit by about 2/3%, which adds up to 8% per year. That's far more significant than the bend point adjustment. What you should do right now. Let me give you a quick action plan based on these 5 changes. If you're already receiving benefits, check your My Social Security account to confirm your new 2026 benefit amount. Review your Medicare coverage during the open enrollment period. It ends December 7th. If you're working, calculate whether you're close to the earnings limit. And budget for that Medicare premium increase. It's real money. If you're still working and not yet claiming, check your Social Security statement to confirm you have, or are on track to have, 40 work credits. If you're a high earner, update your budget for the increased Social Security tax on that higher wage cap. If you're part-time or in the gig economy, make sure you're earning at least $7,560 to get your 4 credits for 2026. If you're thinking about claiming soon, understand the earnings test if you plan to keep working. Consider whether waiting until full retirement age, or even age 70, makes sense for your situation. And run the numbers on how the 2026 bend points will affect your benefit calculation. So there you have it, 5 Social Security changes coming in 2026. The 2.8% COLA increase that's partially eaten up by Medicare premium hikes. The higher wage cap that'll cost high earners an extra $520. The increased work credit threshold that makes it slightly harder to qualify. The higher earnings limits if you're working while collecting benefits, and the increased bend points that affect your benefit calculation. At least one of these changes affects you, and depending on your situation, maybe all 5 do. The key takeaway? Stay informed and be proactive. Social Security changes every single year, and the people who understand these changes are the ones who make better decisions about when to claim, how much to work, and how to maximize their lifetime benefits. If you found this helpful, smash that like button and subscribe to the channel. I post videos every week breaking down Social Security, Medicare, retirement planning, and all the other financial topics that actually matter for your future. Drop a comment below and let me know, which of these 5 changes affects you the most? Are you already collecting benefits and worried about that Medicare increase? Are you a high earner frustrated about the wage cap? Let me know. I want to hear from you. Thanks for watching, and I'll see you in the next video.